Hi, and welcome to another webinar from Advanta IRA. Today we'll be discussing the Secure Act, which is a new piece of legislation that has come into effect this year that everyone with an IRA or anyone that is ever planning on doing some retirement planning or estate planning is very much in need of. My name is Alex Perney. I'll be your presenter today. I've been with Advanta for about 8 years now, and I'm a certified IRA services professional, and have become the resident go-to for the information on the Secure Act. And I have indeed read the entire amount of legislation from front to back a few times. So if you do have any questions, please feel free to contact us. My direct contact information is up on your screen right now. This is a re-recording of the original broadcast that we did of this. We do apologize for that. There was some issue with the recording on the provider's end, and we lost the original. But I did save all the questions, and I will be going through all of the original questions asked during the live presentation. And again, if you do have any questions after this, feel free to give me a call directly or shoot me an email, and I'll be happy to address those. Now, it is especially important when we're covering topics like this that we disclaim what exactly we are doing. We are not providing legal, tax, or investment advice, nor do we endorse any products or strategies with related to this topic today of the Secure Act. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment or structuring strategy related to this new legislation. Now, I'm going to cover several key topics of this. This legislation is very dynamic in regards to what it actually affects for different people. Now, some people may be greatly affected by this. Some people may not see much of an effect at all. But it's important to understand that this legislation has a lot of different facets to it. We will be putting out some blog posts on our website at advantaira.com, but we'll be covering the large points today that a lot of people will have questions regarding. One of the big items that has come up is the removal of the IRA contribution limit for traditional IRAs and the movement of the age of required beginning date for traditional IRA required minimum distributions. Individuals in the year of 2019 were only able to contribute up until the age of 70 and 1/2 to a traditional IRA. Now, even if you had earned income and were still working, still receiving W-2, Schedule C earned income, you could not contribute past the age of 70 and 1/2, and you also had to start taking required minimum distributions from a traditional IRA at the age of 70 and 1/2 as well. This new act for the taxable year of 2020 gets rid of the cap on being able to contribute to a traditional IRA. So now individuals over the age of 70 and 1/2 can make contributions until they stop working or receiving earned income, essentially until death. And they also don't have to start taking required minimum distributions until the age of 72. This is important for many different aspects. One, it allows individuals to keep more money growing tax deferred and compound that interest or those returns on their investments for longer. And secondly, especially for individuals who are our clients, people that have highly illiquid assets or assets that maybe are generating fees, such as a piece of real estate that have taxes that need to be paid. We've seen clients in the past run into issues where they will need to pay something like a property tax bill or an insurance bill. And if they don't have a commensurate cash flow from the property to cover these expenses, it creates quite a bit of issue for them with regards to maintaining that type of asset. And otherwise, sometimes they are forced to liquidate or sell the asset when they otherwise wouldn't have to. Now, with this new legislation, they can contribute those funds, and so long as that the expenses and contributions are aligned, they can make those contributions to pay those types of expenses so they don't have to potentially liquidate or sell an asset that they don't want to. For self-employed individuals, we have a big piece of legislation in this act that will greatly affect your flexibility in establishing a retirement plan for your business. Now, previously, the only types of retirement plans that you could establish after the given year, so January 1 to December 31, after that taxable year, were the SEP IRA and Simple IRA. Now, these types of plans, although great in their ability for people to save more for retirement, especially for small business owners, a very popular plan, the Solo 401k, you had to establish within the defined year, an example, December 3rd or January 1 to December 31, in order to be able to make any contribution for that taxable year. What this new legislation does is it allows individuals going forward to establish and adopt a 401k plan the following year for making their non-elective deferral payments in the previous year. Now, you may be limited to the ability of yourself to defer your compensation, so your elective deferral up until your filing date plus extensions, but we know what at least is written, and some of these things are, again, going to be rather dynamic in how they're actually implemented, so we'll need to wait and see, how these things are actually put into play, but you will be able to at least make the non-elective deferral of your 25% of the net operating income of the business to the plan not to exceed $35,000 per participant up until the filing date plus extensions of the business that you've established this plan for. Now, keep in mind that you will still need to go over all of your plan compliance. If you have employees or you've changed employment status, you may have to look at things going back into that year as to whether or not you are able to establish certain types of plans if you had employees and then maybe drop them or change the actual structure, of your business. So this is something to be taken at a very high level view, is that you now are able to adopt those plans. At the end of the year, it honestly was some of the busiest time for us with having to help people get 401k plans established, and it will greatly reduce the amount of stress for the business owner to try to determine whether or not that they have a viable situation to adopt a plan by giving them the extra time to do it in the following year. So this is definitely something that is going to be very beneficial for a lot of people with regards to being able to adopt a 401k plan much later than they otherwise would have. Oh, and one last item is that you must use the IRS filing dates, not your internal accounting tax year. So if you maintain a tax year that is off of a different calendar than the IRS filing dates, you do have to use the IRS timely filing date or the corporate extended filing date for the adoption of these plans. You can't go off of an internal business calendar year. So it's important to remember. I know some businesses have closeout taxable years at different times throughout the year, but you need to look at it from the perspective of what is the IRS's filing date, and that's what you're going to draw your adoption date, the final adoption date on, if you're filing timely or with an extension. Now, one very good piece of this that has come out, I really do, in all earnest believe that this is a good thing, is the childbirth and adoption distribution allowance. Individuals can take $5,000, a $5,000 distribution within 1 year of the birth or an adoption in order to pay for expenses related to that childbirth or that adoption. Now, the really nice part about this is that there is no time limit to roll those funds back into the IRA. So there's no penalty for this distribution, and you can always, up until you have that entire $5,000 paid back, there's no time limit on it. So you could take 1 year to repay it or 20 years to repay it. So long as you don't exceed that $5,000 initial distribution, you can roll that back as long out as you want to, or you don't necessarily ever have to. You just have the ability to do so. Now, one carve out is that this cannot be used for the adoption of a spouse's child. So if you marry an individual and they have a child and you would like to legally adopt them, that this distribution cannot be used for any expenses related to that. Now, I was asked a question, and it's something that we also don't have any clarity on, but this is something that will come out in later dates, and we're probably going to do a revision of this webinar with what we've learned throughout the year of the implementation of this, is if an individual is having, let's say, twins, or they are adopting more than one child, does this allow for more than one $5,000 distribution to be made at one time? Presently, we don't know. In reading it, it does not give any clarification as to that type of situation. I would think that that would be the case, but I, in all honesty, don't know, because the legislation as written does not give us a clear definition of if the $5,000 distribution is from the birthing event or the adoption event, or per individual person that is either being born or adopted. So that's something definitely to look at in the future with regard to the childbirth and adoptions distribution that was written into law. Now, with 401ks, there is a minimum threshold for allowing people to be participants in that plan. Previously, you had to include any individual who worked over 1,000 hours of service for you in a given year. You had to extend the plan to that individual in a compliant fashion to make sure that they had the ability, if they wanted to participate in the plan. Now, this may very well seem good, and it does have its roots in very good-hearted legislation. However, for individuals that are self-employed or maybe only employ seldom part-time individuals, but want to, include them on things like workman's comp, or don't necessarily always want to hire individuals as independent contractors, it creates a lot of administrative overhead for these plans to administer a plan that has multiple employees and that is not a solo 401k can get rather expensive rather quickly. And the ability to exclude people from that plan if they are not full-time employees or if they maybe just don't want to participate is a very key factor of this. Now, the big change, I mentioned that previously it was any individual that worked 1,000 hours per more for you in a calendar year. That has been actually reduced. So now any employee who works 500 hours per year for 3 consecutive 12-month periods must be offered participation in that plan. And if they switch from a very small part-time, of 500 hours a year is a very small amount of part-time labor. And if they switch at any time to full-time within that time period, they also have to be, those 500-hour 12-month periods have to be considered a full year of service for vesting schedules. Now, what that means is that if you have a order of vesting for individuals participating in a plan, it's a way to reduce overhead and help to retain employees for your business. So if anyone's ever heard of, hey, I have to work 5 years to make sure I get all the money out of my 401k, what that means is that the amounts of money that the 401k plan provider, so your employer, provides to that plan on your behalf on an annual basis, so not what you take out of your paycheck, but what they match to you, they can say, after 5 years, you will get 100% of those contributions if you leave employment. Now, what this allows for employers to do is to help retain individuals for long-term periods of time. It gives them a good incentive to stay, but it also helps to reduce their operating overhead if they have a lot of short employment or seasonal employment. It allows for them to still give people an incentive to participate in the plan, but also lets them recoup some of their money if that individual were to leave. Now, for this, if you have a very part-time employee, you're someone that works very little for you, just over $500 a year, you have to consider those full years of service with regards to a vesting schedule. So it further reduces the ability for employers to save money on these plans and be as flexible as they like to. So it can definitely have the unintended purpose of creating a very large burden for small business owners to administer 401k plans, and that might have the detriment of them offering them in the future as well. So we'll see how this plays out. I believe that this one is probably going to stick. It has very broad support, and it's just not something I see going anywhere. Now, there are some exceptions made for employees who are covered under collective bargaining agreements, but for the majority of people listening to this webinar, if you're a small business owner, you are certainly not entering into a large collective bargaining agreement with your employees if you only have 1 or 2 employees or no employees. So that exception does not really apply to many people, but it is important to understand that a lot of what we're putting out here and what we're educating you on, if it is a new restriction on something you're doing, that it typically is exempted if it was done through a collective bargaining agreement. So that's important to remember. So if you are employed by a larger employer, or you do employ unionized workforces or ones that have collective bargaining agreements, it's important to understand that there are some exceptions for individuals or for employees that are covered under those types of arrangements. Now, what a lot of people have probably tuned in for is the elimination of the stretch IRA. This is a big one. So currently, or I should say previously, an individual who died and left their IRA to anyone other than their spouse, that individual who inherited the IRA had the ability to distribute the funds in several different ways. One, they could disclaim their inheritance and say, I don't want it, walk away. Two, they could take a full distribution of that account, just liquidate the assets or write a check for everything or just fully distribute it. They pay the taxes potentially, and they go on their way. The third option was that they were able to take a periodic 5-year distribution, periodic distributions over 5 years to completely deplete the account. That was one option. And then the fourth option, which was the most popular, was to stretch the IRA distribution payments over their single life expectancy. So that way they potentially could have lifetime cash flow for that beneficiary. And if it was a Roth IRA, literally a lifetime of tax-free benefit for that individual. Now, what this new legislation has done is it has removed the ability of a non-spousal beneficiary to distribute an IRA over the entirety of their life expectancy. What they must do if they are of the age of majority, and this is kind of a big contention point, at least in what I've read, is that the age of majority is broadly defined by states, not the federal government. So when they say an individual receiving an account that is not of the age of majority, there is definitely some ambiguity in that. So we're going to have to wait to see what that means. So let's say an individual is 21 years old, or 25. They receive a IRA from their grandparents. This individual would then have to have the entirety of that account distributed by the end of the 10th year following the date of death of that individual. So this creates a very large amount of potentially taxable income to that individual. It removes the ability to shelter gains and to defer tax payments long into the future, and creates a large amount of assets that are now available to be taxed again after they are distributed to that individual as well. Now, spouses are still allowed to treat an IRA as their own if they inherit one from a spouse and do not have to deplete it over 10 years. This simply is for non-spousal beneficiaries that are receiving these types of accounts. Now, there are some ways that are written into this law that would effectively exempt you from having to take a 10-year distributive payment of the entire account. If you are a non-spouse beneficiary and you are fully disabled, or if you are chronically ill, then you can still do your single life expectancy calculation for distributing that account to yourself. Now, the nice thing is that they also do define mental incapacity in this. So if you have a beneficiary who has special needs due to a mental disability or some type of developmental disability, then this can cover it. They are not going to have to take the distributions over 10 years, which would potentially cause a lot more administrative costs for their care, especially if it was in some type of special needs trust or was being administered by some type of executor for them or power of attorney. It's going to definitely create, or should say maintain, a lot of that flexibility that people currently do enjoy from leaving IRAs to individuals that are of mental disability for their continuing care. And if the account holder invests into a qualified annuity, so an annuity that is issued by an insurance company that is licensed to do business in that particular state in which they operate, and the maturity date of that annuity does not exceed the life expectancy of the beneficiary of that account, then that is another way to get rid of that 10-year distribution rule. However, that annuity does need to be purchased and signed into effect before the individual dies and passes on the account. So it's not something that can be done retroactively after someone passes away. It has to be done beforehand. So there is a lot of things that are going to potentially be challenged, I believe, with these laws. It's not something that is going to be as concrete as it may seem, but with that being said, as they are presently written, this can cause a lot of issues for individuals who maybe have been doing estate planning on a certain set of guided principles for a very long time, but now have to kind of retract those and do a lot of planning, especially if they are old, to see how they can better get in front of some of these things that are going to potentially be causing a lot of taxable issues for their beneficiaries. Now, illustrated in front of you, I have the link to the Ways and Means fact sheet on this bill, and also a link to the Congress full text of the bill as well. Now, I'm going to review some questions, as this is a re-record, part of the part of the large back and forth, and what creates a lot of good content for people listening to these is being able to listen to me answer questions from individuals. So I have downloaded the questions, and I have removed any last names and email addresses from people. So if you are watching this in previously, you can see the questions that are being answered. So we have a couple things. Let me just Okay, so we had Kyle had asked, so you can make employee deferrals for the previous year from January 1 to tax filing now. Let me just go back to that slide. That was in relation to the employer plan adoption dates. And yes, you can make employee deferrals for the previous year from January 1 to the tax filing date. Or sorry, you can only make employer. The employee still needs to do their elective deferral by January 31st. So you can do the employer, which is the profit sharing net operating income match, but you can only do the employee, the $19,000 or $6,000 catch up deferral up until January 31st. Okay, we had someone ask, can I still open a 2019 IRA? Yes, you can still open a 2019 IRA up until your tax filing deadline. Okay. What about if the beneficiary is within 10 years of age or younger than the person who dies? So this was another exception that they had indicated on the stretch IRA removal that I did not include on our slide because I felt it was inherently vague. It had some conflicting information with regard to the other exceptions that they said. So if the beneficiary is 10 years of age or younger than the person who dies, then they would be exempted from the 10-year distribution rule, which would seem to indicate that if the beneficiary, even though a non-spouse, was within 10 years of the birth date of the individual who had died, then they would take their single life expectancy payments as what they would need to do for the distribution. However, it clearly states that it's any beneficiary that is not a primary designated beneficiary must distribute their IRA over 10 years. So the finality of some of the wording of that legislation would lead me to believe that there might be some issues with that. Okay, another question. Do you have any understanding on the details for required minimum distribution age getting pushed back to 72? For example, are the new tables available yet? Also, I read in your other guidance on the following and don't understand what this means from the perspective of an employer. Delaying RMDs is not mandatory, and plan sponsors can choose to retain plan features as provided to age 70 and a half. So the first part of this question deals with a retirement plan sponsored by an employer, so 401ks. Now, with the removal of the current required beginning date, so having to do required minimum distributions by the age of 72 instead of 70 and 1/2. For IRAs, that's across the board. So for any traditional IRA, that's the case. Now, with a 401k, since there is a little bit of different legislation and an adoption agreement that goes along with it, the employer signs, the ability of them to maintain a year of 70 and 1/2 for the required beginning date of distributions would essentially be variant on their preference when they adopt the plan. And also with regard to that, I would think that any type of collective bargaining agreement, as again mentioned in in this presentation, would supersede that and create a scenario in which that either the 70 and 1/2 or the 72 would be mandated above what the employer is trying to have for their adopted plan agreement. Okay, is the $5,000 distribution within 1 year of adoption of child per child? That kind of goes back to, we're not sure if that's going to be the case or not. So if the individual is adopting more than one child, is that going to allow for multiple $5,000 distributions? We don't know, but it would seem to be that would probably be the case. And I believe that pretty much answers all the questions that we had for this presentation. Again, my name is Alex Perney, so if you do have any questions, feel free to give us a call. I will make sure that the last slide of this is going to be our contact information, so feel free to give me a call. I'm more than happy to help with any questions that you might have regarding the Secure Act and what we can do here at Advanta to help inform you better and make sure you have the correct information for doing your estate planning correctly. Again, we are not tax advisors, so we can't stress enough that you do need to contact a tax or legal advisory agent in order to make sure that you get the correct information for your particular financial situation to best move forward. So again, thank you everyone for listening today. And if you have any questions, please give me a call, 727-754-9954 or aperney@advantaira.com. Thank you.